There's a pattern in financial history that repeats with the regularity of a metronome, and almost nobody sees it coming until it's too late. Every generation believes their moment is different, that the old rules no longer apply, that this time the prosperity is built on solid ground instead of borrowed money and mass delusion. And every generation is wrong in exactly the same way. In 1637, Amsterdam experienced the world's first recorded speculative bubble. The asset wasn't stocks or real estate, it was tulip bulbs. At the peak of what historians call tulip mania, a single bulb of the Semper Augustus variety sold for 6,000 guilders, roughly the price of a luxury mansion along Amsterdam's canals. People mortgaged their homes to buy flowers they never intended to plant. Sailors arriving in port were arrested for eating tulip bulbs they thought were onions, destroying fortunes worth more than their ships. Then, in February 1637, prices collapsed. Within weeks, tulip contracts lost 99% of their value. Families were ruined, fortunes evaporated, and the Dutch economy sank into a depression that lasted years. Fast forward to October 1929. Wall Street had enjoyed the greatest bull market in American history. Stock prices had tripled in 5 years. Ordinary workers were quitting their jobs to day trade. Brokers lent money at leverage ratios of 10 to 1, allowing people to control 10,000 worth of stock with 1,000 down. The logic was simple. Stocks only go up, so leverage multiplies your gains. Then, over 4 days in late October, the market lost nearly 25% of its value. Billions of dollars in paper wealth vanished, banks failed, businesses collapsed. Unemployment would eventually reach 25%. The Great Depression had begun. Jump to 2008. American housing prices had risen for 15 consecutive years. Banks had invented mortgage-backed securities, complex financial instruments that supposedly eliminated risk by bundling thousands of home loans together. Credit rating agencies gave these securities their highest safety ratings. Investment banks leveraged themselves 30 to 1 to buy more. Homeowners took out loans they couldn't afford because prices always went up, and they could always refinance. Then housing prices stopped rising. Mortgages began defaulting. Securities collapsed. Lehman Brothers, a 158-year-old investment bank, went bankrupt. The global financial system nearly froze completely. Governments spent trillions to prevent another Great Depression. And even then, millions lost their homes, jobs, and savings. And now, in 2026, the same pattern is building again. The assets have changed: cryptocurrencies, private equity, sovereign debt, leveraged corporate loans, but the psychology is identical. Prices that seem insane by historical standards are justified by new narratives. Risk is dismissed because things have been going up for so long that decline seems impossible. Debt is piling up at every level: personal, corporate, and governmental. Because borrowing money to buy appreciating assets feels like genius right up until it becomes catastrophe. And once again, the people who warn about the pattern are dismissed as pessimists who don't understand how things are different this time. But things are never different. The technology changes, the asset class changes, the specific narrative changes, but the underlying mechanics of the debt cycle have remained the same for nearly 400 years. And those mechanics follow a pattern so reliable that once you see it, you can't unsee it. The cycle begins with a period of genuine growth. Some new technology or market opportunity creates real value. In the 1630s, it was global trade making the Dutch Republic wealthy. In the 1920s, it was electrification and automobile manufacturing transforming the American economy. In the 2000s, it was the internet and globalization creating genuine productivity gains. In the 2020s, it's been technology companies and asset inflation driven by unprecedented monetary stimulus. The important thing is that the initial growth is real. It's not a scam. It's not a delusion. Actual wealth is being created. But then the psychology shifts. As people see their neighbors getting rich, fear of missing out takes over. Investment stops being about careful analysis of value and starts being about not getting left behind. This is when prices begin to detach from fundamentals. Tulip bulbs weren't worth mention. Stocks in 1929 weren't worth 30 times earnings when corporate profits were flat. Houses in 2007 weren't worth $500,000 in cities where median income was $50,000. But prices kept rising anyway because the narrative shifted from "this is valuable" to "prices are going up, so I need to get in before I miss the opportunity." This is where debt enters the equation and accelerates everything. As prices rise, lenders feel safe lending more. After all, if you lend someone money to buy an asset that's appreciating, the collateral is getting more valuable every day. It feels risk-free. Borrowers, meanwhile, see debt as a tool for amplifying gains. Why use your own money when you can borrow at 5 to buy an asset appreciating at 15? The math seems to guarantee profit. So both sides of the transaction become more aggressive. Lenders ease their standards. Borrowers take on more leverages. And the debt fuels further price increases, which encourage more debt, which fuels more price increases. It's a feedback loop that feels like a perpetual motion machine of wealth creation. At this point, the people who warn about danger are dismissed. Critics who point out that prices are detached from fundamentals are told they don't understand the new paradigm. In 1637, skeptics didn't understand the global tulip market. In 1929, they didn't understand modern industrial capitalism. In 2008, they didn't understand securitization and risk diversification. In 2026, they don't understand blockchain technology or the new monetary policy frameworks. The narrative always sounds sophisticated. It always has just enough truth to be plausible. And it's always designed, consciously or not, to justify continuing the behavior that's making everyone feel rich. Then comes the trigger. It's almost never the thing people are watching. In 1637, it was a failed auction where a seller couldn't find buyers at expected prices. In 1929, it was the Federal Reserve raising interest rates to cool speculation. In 2008, it was the realization that subprime borrowers were defaulting at higher rates than models predicted. The trigger itself is often small, but it exposes the underlying fragility, and the reversal begins. This is where the debt turns from accelerant to poison. When prices were rising, debt magnified gains and felt brilliant. When prices start falling, debt magnifies losses and becomes catastrophic. If you borrowed $9,000 to control $10,000 worth of stock and it drops 20, you've lost not 20 but 200. You've lost all your capital and now owe money on top of it. Faced with that math, investors panic and sell, which pushes prices lower, which creates more panic, which creates more selling. The same feedback loop that drove prices up on the way up drives them down twice as fast on the way down. Lenders who felt safe when collateral was appreciating suddenly realize they're holding loans backed by assets worth less than the debt. They stop lending, they call in loans. They demand more collateral. Borrowers who were counting on being able to refinance or sell at a profit find themselves trapped. They're forced to sell at losses. Businesses that were profitable when credit was cheap become insolvent when credit disappears. The entire system, which seemed robust during the boom, reveals itself to have been fragile all along, held together not by genuine strength, but by the collective belief that prices would keep rising. And here's the most painful part. The people who benefit most during the boom are rarely the ones who suffer most during the bust. Insiders who sell early keep their gains. Large institutions get bailed out by governments desperate to prevent systemic collapse. It's the ordinary people, workers who lose jobs, homeowners who lose houses, retirees who lose pensions, who bear the real cost. The tulip speculators who sold in January 1637 kept their mansions. The Wall Street bankers who cashed out in 1928 retired wealthy. The hedge fund managers who shorted subprime in 2007 made billions. The pattern doesn't just repeat economically. It repeats in terms of who wins and who loses. So where are we now in 2026? Every indicator suggests we're in the late stages of another cycle. Global debt has reached $315 trillion, the highest in history, both in absolute terms and as a percentage of global GDP. Central banks have spent 15 years suppressing interest rates to emergency levels that were supposed to be temporary. Asset prices across stocks, bonds, real estate, and alternative investments have risen to valuations that historically precede corrections. Corporate debt is at record levels, with many companies borrowing not to invest in growth, but to buy back their own stock. Consumer debt is rising as people borrow to maintain lifestyles in an era of stagnant real wages. Sovereign debt is exploding as governments run deficits even during economic expansions. And yet, the narrative remains that everything is fine. Cryptocurrencies are dismissed as assets not because they're in a bubble, but because skeptics don't understand decentralization. Stock valuations of 30 times earnings are justified by low interest rates, creating a new paradigm. Government debt is sustainable because countries that borrow in their own currency can never default. Real estate prices are high because they're not making any more land. Every concern is met with a sophisticated-sounding explanation for why this time is different. But it's not different. It never is. The debt cycle doesn't repeat because people are stupid or irrational. It repeats because the boom creates powerful incentives to ignore the warnings. When your neighbor is getting rich trading stocks and you're saving responsibly, it feels like you're the fool. When your company's competitors are leveraging up to grow faster and you're staying conservative, it feels like you're falling behind. When governments are borrowing to fund popular programs and some economist is warning about future debt burdens, it feels like pointless pessimism. The psychology of the boom makes caution feel like cowardice and recklessness feel like wisdom. This is why financial crises keep happening even though we study the history and swear we've learned the lessons. We have learned the lessons intellectually. Anyone can describe the debt cycle. But learning intellectually is different from acting on the knowledge. When acting means stepping away from gains while everyone else is getting rich. It means selling when prices are still rising. It means looking foolish for months or years before being proven right. Most people, most institutions, and most governments can't do it. They know the history, but they can't bring themselves to act on it until it's too late. So what happens next? The pattern suggests a trigger will emerge, probably something unexpected. Possibly something small that will reveal the underlying fragility. Credit will tighten. Asset prices will fall. Over-leveraged entities will face insolvency. Governments will intervene with massive fiscal and monetary stimulus, preventing total collapse, but creating new distortions in the process. A recession will occur, possibly a severe one. Unemployment will rise. Political instability will increase as people demand accountability and governments look for scapegoats. And then, after the pain subsides, after the deleveraging completes, after the excess gets wrung out of the system, the cycle will begin again. Because humans have short memories and strong incentives to believe that growth can continue forever if we just manage it properly. A new generation of investors who didn't experience the last crisis will drive the next boom. New technologies will create new narratives about why old rules don't apply. And once again, debt will fuel a rise that feels permanent right up until the moment it collapses. The debt cycle isn't a flaw in the system. It is the system. It's how capitalism operates, cycling between growth and correction, boom and bust, mania and panic. The question isn't whether another crisis will come. It's when and how severe, and whether we'll recognize it before we're in the middle of it. History suggests we won't. We never do. Because recognizing the bubble requires admitting that the wealth isn't real, that the gains are built on leverage and speculation rather than genuine value creation. And that's a truth that almost nobody wants to face until they have no choice. The tulips weren't worth mansions. The stocks weren't worth 30 times flat earnings. The houses weren't worth $500,000 in towns where nobody earned six figures. And whatever assets we're overvaluing today, cryptocurrencies, government bonds, tech stocks, commercial real estate, they aren't worth what we're paying either. We know this. Somewhere deep down, we all know this. But knowing and acting are different things. And that's why the pattern repeats. In 1637, 1929, 2008, and soon, very soon in 2026 or shortly after, the debt cycle will complete again. The only question is whether you'll see it coming.